You know the name from the NHL and NFL sidelines, right? You see their cars on basically every highway and their motorcycles on every city street. But do you really know the financial engine operating behind that iconic H logo? Because if you just read the recent headlines, you might actually think Honda is hitting the brakes. They recently reported a massive operating loss that frankly sent shockwaves through the market. But right beneath that headline-grabbing number lies a trillion-yen hidden gem of an opportunity. Today, we're bypassing all that surface-level noise and digging straight into Honda's official FY2026 financial presentation to uncover a cash-generating machine that smart investors are just starting to notice. So this is the number that literally had everyone talking. For fiscal year 2026, Honda reported a consolidated operating loss of negative 414.3 billion yen. I mean, when you see a number like that from a global manufacturing giant, it immediately triggers alarm bells. You start wondering, is Honda in deep financial trouble? Are their vehicles suddenly just not selling? Are they losing their grip on the global market? It's so easy to look at a nearly $500 billion loss and just assume the underlying business is fundamentally broken. But as focused learners and smart investors, we know the reported number rarely tells the whole story. Okay, let's dive into this because this is exactly where the narrative completely flips. And hey, before we break down these billion-dollar numbers, make sure to subscribe to our channel. We provide deep dive explainer analyses like this on global giants so you can always stay ahead of the market. Now, let's look at what's really happening. When we strip away all the accounting noise, the real story emerges. We contrast that reported loss of negative 414.3 billion yen with their adjusted operating profit, and suddenly we're looking at a positive 1.039 trillion yen. Yes, trillion with a T. That's a massive, highly profitable core business operating entirely in the shadows of a scary headline. So how do we bridge the gap between a 414 billion yen loss and a 1 trillion yen profit? What exactly caused this massive distortion?
Well, the unfiltered data points directly to the culprit. And just a quick note, everything we discussed today is based on Honda's official financial results released in May 2026. So this is direct, unfiltered data right from the source. Taking a look here, the official summary details a 1.45 trillion yen EV-related loss. Basically, Honda took a massive one-time paper restructuring charge to completely overhaul their electric vehicle strategy. This wasn't cash flying out the door from selling cars at a loss, guys. This was a strategic accounting decision to clean up their balance sheet. They aggressively wrote down assets to realign with the current realities of the EV market. Excluding that specific, targeted hit, the actual business generated over 1 trillion yen in profit.
Section 1. Two-wheel dominance, global market strength. To truly understand where that trillion yen of real cash flow is actually coming from, we have to look past the four-door sedans and focus on two wheels. Because Honda isn't just participating in the motorcycle market, they are completely dominating it. In FY 2026, their two-wheel segment achieved record-high unit sales and profits. This massive growth is being driven aggressively by emerging markets, specifically India and Brazil, where the demand for efficient, reliable transportation is just skyrocketing. And while they dominate the globe on two wheels, over in North America, they're maximizing their four-wheel cash flow by strategically shifting focus back to highly profitable internal combustion engines, or ICE, and hybrid vehicles. They're basically feeding the market exactly what it currently demands, which maximizes cash flows right now while the global EV infrastructure takes its time to mature. And this illustrates it perfectly. The Q4 business segment results show that the motorcycle division, the two-wheel business, posted an incredible 17.1% operating margin. In the world of mass manufacturing, a 17% margin is absolutely spectacular. This proves that Honda's foundational cash engine is not only intact, it is healthier and way more profitable than ever before. They're using this high-margin cash cow in Asia and South America to fund their strategic maneuvers globally. Section 2. Shifting EV strategy, a calculated pivot.
Which brings us to the elephant in the room. If the core business is literally printing cash, why intentionally generate a headline loss? Well, it comes down to calculation. Honda is solving the EV transition problem by just being remarkably realistic. First, they acknowledge the changing realities of the global EV market. Adoption rates are shifting and consumer preferences are constantly evolving. Second, instead of slowly bleeding capital into a strategy that just no longer fits reality, they chose to rip the Band-Aid off. They took a massive one-time financial hit right now to realign their assets and development pipelines. And third, this frees them up to focus aggressively on what consumers actually want to buy today: highly efficient hybrids and ICE vehicles. They're actively protecting their long-term margins instead of stubbornly chasing unprofitable EV trends.
Now, what's really interesting about this slide is this year-over-year operating profit waterfall chart. It visually maps out the whole strategy. You can see the positive impacts from pricing, cost reduction, and volume changes steadily building the profit up to that 1.039 trillion yen mark. Then you see that sheer cliff drop, that massive red bar representing the 1.45 trillion yen EV-related loss, which drags the final reported number all the way into the negative. This clearly proves that the operating cash flow from their core business operations is immense, and the loss is entirely ring-fenced within that specific strategic EV reset.
Section 3. Rewarding shareholders and dividend returns.
So, what does a clean balance sheet and high cash flow mean for your portfolio? This brings us to the most exciting part of this explainer, because despite reporting a massive paper loss for the year, Honda is absolutely not cutting its payouts. They are maintaining a strong, stable annual dividend of 70 yen per share. Just think about the confidence that requires. Management is essentially saying to you, hey, we know the headlines look bad due to our restructuring, but our actual cash generation is so incredibly strong that we aren't reducing your dividend by a single yen.
But they aren't just maintaining the status quo either. They're actually building on that momentum. Honda is officially introducing a new dividend on equity, or DOE, target of 3.0%. Now, this is an absolutely crucial metric for focused investors to understand because it fundamentally changes how shareholders are prioritized. By introducing this official 3.0% DOE target, Honda is essentially guaranteeing a commitment to stable, consistent payouts based on shareholder equity, rather than tying dividends strictly to the ups and downs of yearly earnings. When a company undergoes a massive restructuring like Honda just did, earnings can obviously be incredibly volatile. A DOE policy cuts right through that volatility. It assures investors that regardless of short-term, paper-based earnings fluctuations, the company is committing a steady percentage of its equity straight back to the shareholders. It's a massive signal of financial health and real investor prioritization.
Section 4. FY2027 Outlook and Financial Forecast.
So, with the EV restructuring behind them and a locked-in dividend policy, what does this strategic reset actually mean for the next fiscal year? Well, looking at the official FY2027 forecast, now that the one-time trillion yen EV charge is completely off the books, Honda is forecasting a swift return to a reported operating profit of 500 billion yen. And check out that adjusted operating profit figure right next to it. They're forecasting it to hold steady at that massive 1 trillion yen level. They expect to continue leveraging their wildly profitable motorcycle business and their high-demand hybrid vehicles in North America to maintain that incredible baseline of cash generation. So the crucial point here is this. Please do not let a single year's reported operating loss fool you into thinking a company is struggling. Honda took a proactive, strategic hit to fix their EV roadmap and really clean up their balance sheet. Underneath that accounting move is a company dominating the global motorcycle market with 17% margins, smartly pivoting to high-demand hybrids, sitting on immense cash flow, and locking in a highly favorable 3% dividend policy for its shareholders. With a strong net cash position of 3.3 trillion yen, they are a financial powerhouse in disguise, effectively positioning themselves as a highly profitable recovery play. Which leaves us with one final thought to ponder. With a clean slate for FY 2027, a trillion yen in adjusted profits, and a steadfast commitment to rewarding shareholders, is Honda the market's most misunderstood cash machine? It's exactly why we look past the headlines and dive into the real data. The loss was a strategic reset, but the future? It's a cash-generating machine. Thank you so much for joining me on this explainer, and we'll see you in the next deep dive.